It's kind of interesting. The United States of America has gone from becoming the land of the free to the land of those in debt. Now, the nice thing about living in a country like America is, well, you have a lot of opportunity. You have the opportunity to start a business. You have the opportunity to invest your money, but you also have the opportunity to buy whatever you want with the help of easy credit, with easy debt, and buy now, pay later, or as I like to call it, broke now, broke later. But I want to talk about debt in a couple of different ways. First, let's talk about now on the investment side, what's this good debt and bad debt that people like to talk about, and is there such thing as good debt? And then I also want to talk about how you can potentially pay down this debt. And I want to end this lesson by talking about credit card debt because, well, credit cards are an interesting topic that I'm going to save for the end of this lesson. Let's start by talking about this whole idea of what is good debt versus bad debt. And the argument that people make is that bad debt is when you go out and you finance something that's losing you money. When you go out and you finance your car, you finance your wardrobe, you finance a vacation. This is bad debt because now you're spending your future income to buy something that's losing money. Remember, debt is you spending your future income today. Good debt, people argue, is now when you're using other people's money, the bank's money, to go out and buy an asset that's paying you money. So going out and borrowing money to buy a rental property that will then pay you for owning it. And then you use this asset, like the rental property, to pay down the debt. And because now the asset is paying down the debt, it's considered good debt because, well, it's making you more money. But I want to challenge that a little bit because, well, I believe all debt is bad debt. But that doesn't mean you can't use it to make you money. And the reason why I say this is because, well, I have seen situations where I have purchased these good debt deals which turned bad very quickly. In fact, one of the best real estate deals that I ever purchased was this apartment complex from one of those real estate gurus, true story, who taught people how to buy apartment complexes with no money down. And on his website was a picture of this guy standing in front of this 20-unit apartment complex saying, look at how I bought this property with no money down. He purchased this apartment complex for a little bit over $1 million. He had a lot of debt on the property. He had multiple different lenders on it. The problem was he didn't really know how to manage the property. He also didn't really know how to manage the debt. So long story short, people started to leave the property. He wasn't managing it well. He stopped making money. He couldn't keep making the debt payments. The bankers wanted their money. So they were forcing him to sell, but nobody was willing to buy the property because of how madly it was being managed. And that was when this property was on sale for about $435,000, less than 50% of what he bought the property for. In fact, it was around 40% of what he purchased the property for. That was when I came in and I made an offer for $425,000, which was rejected because somebody else wanted to buy the property. And so I didn't buy it. But that person who wanted to buy the property was then going through the due diligence and then for whatever reason decided to back out. And that was when the broker called me back and they said, hey, this person didn't go through with buying the property at $435,000. Will you buy it for $435,000? And I said, no, but I will buy it for $425,000. And now, because the lenders had already gone through this due diligence period with somebody else, they were more likely to accept my offer because now they were more desperate to close because their costs kept going up. I mean, every month that you own an asset, you have expenses. And so that's how I was able to buy this property for $425,000 because that good debt turned bad. Now, hear me correctly here. This doesn't mean that you shouldn't use debt or that debt is something that you want to always avoid. This means understand the risks with debt. The reason why I don't like to call all debt good or bad debt and good debt is because, well, all debt will turn bad if you don't take care of it properly. And this is where you need to understand how to use debt. Can you use debt to buy assets like businesses and real estate to make you more money? Absolutely. But that good debt can turn bad if you don't know how to manage it, if you don't know how to nurture it, and if you don't know how to take care of the asset correctly. And this is the reality about debt. So yes, there is this quote unquote debt that can be used to make you money. There's this debt that will lose you money. Do not go out and finance things that aren't making you any money. Stop financing your Gucci. Stop financing vacations. We already discussed this. This is something you should not be doing. But when it comes to assets, your real estate, your businesses, there is potential now to use debt, but you have to use it strategically and understand that when you use more debt, you're taking on more risk. And more risk means it's going to need more financial education on your part to be able to manage the asset and manage the debt. Because if you don't know how to either manage the asset or the debt, well, that good debt is going to turn around and bite you in the you know what. Number one, you got to understand the difference between what people like to call this good debt and bad debt, and understand that all debt can turn bad very quickly. The second thing I want to talk about when it comes to debt is now buying things with credit cards and other types of debt like that. And let me start with this. I love using my credit card. In fact, I don't even own a debit card. I prefer to only buy things on my credit card because when I spend with my credit card, I get cash back, I get perks, I get rewards, I get flight upgrades, I get hotel upgrades. But the key here is I never pay a penny in interest ever. See, the way that credit cards work is when you swipe a card, these credit cards will take a fee from the merchant. And if you swipe too much, well, now this credit card is going to take a lot of money from you from interest. And if you are paying this interest, well, now you're paying for everybody else's perks and rewards, at which point this credit card is not worth it. So now when you have these debates about whether credit cards are good or credit cards are bad, the reality is if you can use a credit card as a tool, it can be good. But if you don't know how to use a tool, it can be bad. See, a credit card is just a medium of exchange. I mean, what's the difference between using a credit card and using a debit card? You have more spending ability with a credit card. But if you know how to use your credit card, you can get more perks, you can get more rewards, you can get more cash back. But the last thing that you want to do is use your credit card the wrong way, and now you overspend, and now you're in debt to your credit card company. So the key here now is you have to be honest with yourself. Can you control your spending? If yes, then sure, use a credit card, but never use a credit card to buy something that you wouldn't normally buy just because now you have this piece of plastic. Use your credit card just as a medium of exchange. Now, instead of using cash, instead of writing a check, instead of using a debit card, you're just using a credit card. And because you use a credit card, now you can get some cool perks and rewards and cash back as well. But then the question is, if you have credit card debt, what do you do? And this is where now the very first thing you have to do, if you have credit card debt, is you got to stop using that credit card immediately. You got to get rid of this financial bleeding. Your credit cards are skinning you alive financially. And so if you have any sort of credit card debt and you're paying interest to your credit card company, it is not worth the rewards, it's not worth the perks, and you got to get rid of the credit cards. You got to stop the financial bleeding. Stop using credit cards completely. Now, you have to get aggressive to pay down your credit cards. And I'm going to talk about this here because, well, this is a very important investing concept to understand. If you can go out and invest your money into the stock market and real estate market, generally you're looking for a 7 to 10% return on your money. But at the same time, your credit cards are making 12, 15, 18, maybe 25% a year in interest by lending you money. And so what's funny or kind of ironic that you see happen is you'll see people with credit card debt then say, how can I start investing my money in the stock market? Well, if you're trying to get a 7 to 10% return in the stock market, but you're paying 12 to 25% on your credit card, before you go out and put your money into the stock market or real estate market or more of these traditional investments, you have to pay down your credit card debt because this credit card debt is like shackles that is stopping you from building any real wealth. Before you go out and try to earn 7 to 10%, pay down the 12, 15, 20, 25%. And now the question is, how do you pay down this debt? And this now can get into more of the strategic ways of debt pay downs. There's two general strategies of paying down your debt. You can follow what's called the debt avalanche or the debt snowball method. The debt avalanche method says that now you're going to line up all of your debts from highest interest rate to lowest interest rate. So if you have a credit card debt that's charging you 25%, you ignore the principal balance, but you take the highest interest rate to the 25% debt, the 18% debt, the 6% debt, 3% debt, and you line them up by percentage. And now you're going to work to pay down the highest interest rate debt first while making all the other minimum payments, but you're going to aggressively work to pay down the highest interest rate debt first. The debt snowball method is a little bit different. Now, instead of lining up all of your debts by their interest rate, you're going to line up the debts by their principal balance. So you're going to start with the lowest principal balance, then go to the highest principal balance, and ignore the interest rate on the debt. So now you first pay down the $500 principal balance, the $3,000 principal balance, the $75,000 principal balance, and then the $300,000 principal balance. You ignore the interest rates, but you line up the debts now by principal balance, and now you're going to work to pay down the debts by smallest balance first. And the question now is, which one is better? The answer is, it doesn't matter. You just have to stick with the one that's going to allow you to actually pay down your debts. The advantage of the debt snowball method is that it gives you more of the psychological wins because you're going to pay down your first debt sooner than the debt avalanche method, so you feel like you're winning sooner. And if you need those psychological wins, do the debt snowball method. The debt avalanche method is going to allow you to pay less money in interest. And so if you are a disciplined spender and you're the mathematical person and you say, you know what, I just don't want to pay this additional interest. I want to get out of this debt situation as fast as possible, and I want to pay as little interest as possible to the banks, then do the debt avalanche. But at the end of the day, it does not matter which one you pick. The key is that you pick one and you stick with one, and then you pay down these consumer debts that are keeping you from becoming financially successful. And then the next question is, but Jaspreet, what about something like my mortgage? What about the other low interest debts that I have? Should I pay down these debts, or should I start investing my money first? And this is where now it gets a little bit more personal because it's going to depend on you. When it comes to something like your credit card debt, which is a high interest debt, you have to pay that down first before you go out and start investing because you're paying 15 to 25%, but you're trying to generate 7 to 10%. This interest rate on your credit cards is higher than the return that you're trying to get from your investments. So pay down your credit card debt first. But when it comes to your low interest rate debts, now it's a little bit different because now the question is, well, what type of lifestyle do you want to live? Do you just want to be financially free and not have to worry about your payments and not have to worry about money? Or do you want to say, I want to fly first class and I want to have a big mansion and I want to drive the luxury cars? And then the next thing is, well, what is your risk tolerance? Are you a person that wants to just generally avoid risk because you don't like taking on a lot of risk? Or are you more open to taking on risk? Are you more open to doing more potential upside investments, which come with more risks? And then the question is, well, how much investing experience do you have? Do you have no experience? Have you never made an investment before? Or have you been investing for a number of years and now you understand how to buy your rental properties? You know how to buy stocks and analyze companies. Based off of these questions, now you can start to decide, well, is it better for me to pay down my debt or is it better for me to invest my money? And now you just go through the questions. Well, if I just want to be financially free and not have to worry about money and walk in my backyard and just be able to breathe debt-free, then work to pay down the debt first. Because when you pay down the debt, you're going to have no payments. If you want to live large, you want to have a big mansion, you want to fly first class, you want to fly private, you want to have all the nice things, you got to take more risk, which means paying down your 5% debt is not going to get you to where you are. You got to go and grow your money more. If you were a type of person who doesn't want to take on a lot of risk, you're very anti-risk, well, paying down your debt gives you a guaranteed return. When you pay down your 6% mortgage 1 year early, that's a guaranteed 6% return on your money. When you put your money in the stock market or the real estate market, you're trying to get a 6 to 10% return on your money, but there's no guarantee. Maybe it'll be more, maybe it'll be less, maybe you lose money. There's no guarantees when you invest your money versus when you pay down your debt a little bit earlier, you get a guaranteed return. So once you ask these questions, now you'll be able to understand, well, should I pay down my low interest debts or should I go out and invest my money? But when it comes to your higher interest rate debts, you want to pay those down as quick as possible. That means really work to spend less money. That means really work to make some sacrifices. That means really work to earn more money, not so you can have more nice things, but so you can pay down this high interest debt and not to do more things that got you into this debt in the first place. So when it comes to debt, yes, there are ways that you can use debt to make you more money, but all debt is bad debt because if you don't treat your good debt correctly, that's going to turn around and bite you in the asset. The next thing you have to understand is when it comes to a credit card, treat a credit card like a medium of exchange. If you can control your spending, then sure, use a credit card and get the perks. If you cannot control your spending, do not use a credit card. If you have credit card debt, stop using credit cards immediately and work to pay down that debt ASAP. When you're working to pay down the debt, you can follow the debt snowball or you can follow the debt avalanche. It doesn't matter which one you follow as long as you follow it and pay down this debt. When it comes to the question of should you invest your money or pay down your lower interest rate debts, it comes down to now what type of lifestyle do you want to live, what type of risk you're willing to take, and what is your investing experience. The last thing that I want to go over is the DTI measure. DTI stands for debt to income, and pretty much every bank around the world will at some point look at your debt to income ratio if you ever go and get a loan. This is whether it's for an asset, whether it's to buy a home. So I want to briefly talk about what is DTI and how do you calculate that. So debt to income essentially means how much money are you making and how much of this money are you actually paying out in debt. And this is something that you can calculate for yourself. And the way that you do this is now take a look at all of your debt payments. This is your mortgage payment. This is your student loans. This is your credit card payments. Take a look at all of your monthly debt payments and figure out how much money are you paying out in debt every single month. Take that number, multiply it by 12. So if you have $1,000 in debt costs a month, multiply that by 12, that means $12,000 a year in debt payments. Now divide that by your annual income. And you can do this two ways. I want you to divide it by your annual gross income pre-tax and then divide it by your annual post-tax, your net income after paying taxes. And the reason why is because there's different calculations you can do with DTI, pre-tax, and post-tax. And I want you to understand the real numbers because many times what banks will do is they're going to look at your debt to income ratio on a gross level, meaning before taxes. But for your personal level, that doesn't do you much good because you don't actually see that tax money. So let's look at your debt to income on a post-tax level as well. Now you're going to take your annual debt payments and you're going to divide that by your annual income. And this is going to give you your DTI formula. And I want you to do this twice, once for your gross income pre-tax and second for your net income post-tax. And we'll be talking a little bit later in this quest about what you can do with this DTI formula. What I'd like you to do now is just take a picture of your current debt today. What debts are making you money? What debts are losing you money? The debts that are losing you money are any of these high interest debts. If so, what is your plan now to pay this down? Because you're going to have to attack this debt quickly. How can you spend less? How can you earn more to pay down these high interest debts? Then when it comes down to the lower interest rate debts, the question is now, are you going to invest your money or would you rather pay down your debts first? Think about this and write it down. And I also want you to think about, would you rather follow the debt snowball or the debt avalanche method when it comes to paying down your debt? And the last thing that I want you to think about is your credit card. Do you use a credit card? If so, should you be using a credit card? Be honest with yourself. And with that, I'll see you in the next lesson.